Welcome to Brokers Digest, a weekly webcast by The Edge Singapore, where we discover stock opportunities with you. This episode is made possible by TD Ameritrade Singapore.
Proceed.
Good afternoon. Welcome to our all new Brokers Digest live webcast series with guest speaker Chris Brankin, CEO of TD Ameritrade Singapore. Hi, Chris.
Hi, Gula. Thanks for having me. Excited to have this initial event here today.
Yeah, so are we. So over the next 3 months, we will be discussing a range of issues affecting the U.S. markets, from quantitative easing to the U.S.-China trade war and the state of the U.S. equity markets. Our initial focus is likely to be on tech stocks, but we know equity markets are notoriously fickle, and we'll be keeping an eye on the volatility index. So let's get straight into it. NASDAQ. Okay? NASDAQ's been making spectacular new highs. And then at the end of last week, the FT reported that SoftBank was the NASDAQ whale. Chris is going to explain to us in a minute what this is. A NASDAQ whale driving NASDAQ to these levels. According to its report, SoftBank had been snapping up options in tech stocks in huge amounts. Chris, could you explain what all this is? And is this true? What does it mean for the markets? And how will it affect trading this week?
Definitely created some buzz around some of the reports from not only the Financial Times, but the Wall Street Journal, in terms of they were searching for who that whale might be. And in terms of, this is Moby Dick on steroids, SoftBank, some of the terms and size of some of their positions that are, speculated in terms of what they've gotten into tech over the last few weeks and months are substantial, to say the least. Now, they may have driven or helped, kind of add or fuel to the fire of the rally of tech overall. Mm-hmm. Now, I think some of the worries is if they do start to unwind any of those positions, there might be some additional volatility. If you look at it from SoftBank's perspective, it is pretty consistent with CEO Masa saying that it wanted to get more involved, not only with the equity and derivatives market. And in their June filings, they basically changed the way that they were going to report their financial results. So they're no longer considered an operating company, but an investment company. So all these things kind of, reinforce basically what we've seen and now are being reported by, FT and the Wall Street Journal and others in terms of SoftBank's just large bets on the technology departments.
Is there a risk doing it through options, because they're derivatives, and just as stock prices can go up, could they reverse?
Well, stocks can go up, stocks can go down. Markets can stay, irrational longer than you can stay solvent. Something that we've learned many times, and I've said to people over the years. But what's important to look at is the way that they're using options. So they are leveraging up buying equities, and what they're not, I guess, looking to kind of protect some of their investment. What seems to be is they're leveraging up in terms of their overall exposure, which has helped drive the technology rally across all the FANG stocks. Especially some of the big ones, Tesla, Apple, Microsoft, even some of the technology plays like Zoom and others, that we've seen that have been super leveraged here by SoftBank. Now, with a equities trader, what you would see is you have the ability to use options that give you defined risk, use time decay in your favor, and if something that actually has lower risk than buying or selling a stock outright. Now, you can also literally just buy or sell a call, betting on the direction, which allows you to outlay less capital. But there is an increased factor of risk. But if you're buying options, your risk is only on terms of what you paid for up front. As where you're selling options and collecting premium, you collect that premium up front. That's the maximum gain that you can have. But on selling calls, especially if you're selling calls naked or puts naked, meaning you're not doing it as a spread, there's unlimited potential risk, if the position goes, against the direction that you're making a bet in.
Okay. So in terms of valuations and so on, how do you see the tech stocks, in particular the FANGs that you just mentioned, and Tesla and Zoom? And also, what are your customers doing on that tech front?
Yeah, look, I think this is one of the things that I get asked about a lot, not only in media, but investors in general. They talk about valuation. Sure. If you look at it from a valuation perspective, what are we really looking at in terms of technology? You look at normal PE, you basically can, on a lot of these things, you can throw that out the window. Look at Tesla's PE, for example. Amazon's PE, years ago, a lot of this is based on potential, not specifically on what the price earnings ratio is at that point. Sure. In terms of valuation, yeah, the numbers are definitely stretched in terms of a standard looking stock that might be listed on the S&P 500 or Dow Jones. But in terms of overall potential, I wouldn't really, basically think that it is a bearish opportunity simply because you think that the valuation from a normal perspective is stretched. But that being said, we do see that people know that stocks don't go up forever. And at some point, people do take a little bit of their profits off the table and either to look to rotate into a different sector or, maybe just to take some of the risk off the table.
Well, yesterday was a holiday in the U.S., but what were your customers doing? Because I think you can see whether they're net buyers or net sellers of stocks. So
yeah, look, for the last 4 months, it's been risk on for our customers at TD Ameritrade here in Singapore and across the globe, realistically. We've seen a lot of similarities in terms of what our Asian customers trade compared to what our U.S. does. But a lot of that has been a big tech-driven rally. We've seen that really around, the large ones, Apple, Microsoft, even throw Tesla into that, new FANG kind of thing. A lot of this has really been, euphorically driven in terms of the amount of money that is, we've seen the rallies off of the late March lows. And now we saw just last week, with the Apple Tesla split, we saw that as an opportunity where people looked at historically that when these large companies, that split, to kind of bring their stock prices back into a more reasonable levels or allow people to purchase, hundreds, of shares at a time, rather than, just when the stock gets over $1,000 a share, it gets difficult to be able to leverage anything or participate in the options market simply because you don't own enough shares of the stock to be able to sell a call against it. So 100 shares of stock is simply one option, on a standard option, when you look at it. And when you look at some of the stocks, when Apple, it hit over, $1,000 a share, over $500 a share, you saw that, these things, to participate from a retail perspective is definitely more helpful from a retail point of view, that they would like to see the price a little bit lower. And now we're at that, below that 200 level, which is generally has brought investors back in to those particular spaces.
So do you see any more stock splits on the horizon? Alphabet, Amazon, could they do a stock split?
I think, as some of these stocks have hit all-time highs and they've gotten to price levels that are difficult, especially from a retail perspective, for participating. I wrote it down because I just couldn't believe the numbers. $3,300 a share for Amazon, $1,600 a share for Google, Alphabet. So if you're buying 100 shares of stock, it gets very, very expensive at those levels. And then if you want to buy 100 shares of stock and maybe sell a call against it to kind of, limit some of your risk, or you kind of have at least a hedge against that. It's very difficult from a retail perspective. If trades cost, tens of thousands or hundreds of thousands of dollars to buy a few hundred shares of that stock. So I would anticipate, I think markets are looking for, as some of these stocks, not only, Google, which Alphabet, sorry, I can, it's hard for me to ever say Alphabet rather than Google. And Amazon, even Microsoft, you would anticipate that
Microsoft, yes.
the market is looking for some splits on some of these technology stocks that have rallied so high over the last kind of 6 months.
Okay. So, do you think that we could see some rotation, perhaps into cyclicals, which have sort of gone, haven't done as much?
Yeah, look, they haven't been as sexy. They're not
Yeah.
the things that are drawing the headlines, so to speak. But what we've seen is we've seen a little bit of a rotation. So we see our customers have been net new buyers, especially over the last month in terms of technology stocks. But we have seen a little bit of selling, as they take some of those profits off the table. And where do we see other interest from our customers at TD Ameritrade? Not only in Asia, but in the United States, we do see some of that rolling into the cyclicals. And what we see the main focus from our Asian-based clients has been the large U.S. banks, Bank of America, Wells Fargo, is potentially getting into an area where the stock, especially if they maintain their dividends, that their yields are very attractive at these levels. Other thing that we start seeing our customers participate a little bit more in recently is some of the, like I call the kind of, as the world opens back up trade. So this retail shopping, we have this pent up demand, look, especially in the United States. Look, we're fortunate here in Singapore that that most of the children are back at school, rather than on an e-learning base. So we never really had in the U.S. that back to school spend. And then look at it from the back to work spend. So many people sit in their homes these days, wear jeans and a t-shirt. No one's getting dressed up. No one's buying, these clothes. So I think there's this retail pent up demand, not only for electronics, but also for just consumer goods, whether it's clothes and shoes and things that we just haven't had yet. So I think there is a pent up demand there. And we started seeing some of our customers starting to dip their toe into water across the retail space as well.
So what about, I must ask, because this is my favorite subject, what about the REITs and on the property stocks? Because there's not been much interest in that direction in the U.S.
I mean, look, I think, it's a little surprising that, the U.S., is been as flat as it's been, I guess, across, the REITs and home building areas. And a lot of that's based on the U.S. GDP is really driven by, consumer spending and confidence that they're going to have that job. So we've had this unemployment numbers spike up in the U.S. We've gotten numbers starting to get better. We're starting to see some of the manufacturing numbers starting to get better, not only U.S., but Europe, and in Asia. All these things, kind of the underlying economy. Central banks around the globe have helped prop up economies, so to speak, to get to this point. But at some point, we need to start to see actual economic activity to be able to support, the consumer spending that drives GDP in the United States.
Okay, so let's hope we'll see some of those figures coming in the next few weeks and months. Okay, so
Yes.
Thanks so much for your inputs, Chris, and we'll speak to you next Monday, September 14th.
Sounds great.
Yeah. So
All
it's
right.
good. Yeah, so it's goodbye from me here in the studio, and it's goodbye
All right,
from
and
me.
so for me as well.
Okay,
Thank
then.
you.
Thanks.